All right, so I'm so pleased to be here today and sitting with such esteemed people, Phil Duff and Larry Smith. Would you guys please just give a super quick introduction of who you are and why you're here today?
Go ahead, Larry.
Okay. I was at JP Morgan for 18 years, headed up the fixed income group, created an asset allocation area, then left to be the global chief investment officer for Credit Suisse for 4 years, and then left and formed a hedge fund 5 years ago, almost to the day, called Third Wave Global. It's a quantamental, using the latest in verbiage here, and combining both quantitative and discretionary tools. And it is global macro, investing tops down in the world's equity, bond, and currency markets, primarily with some involvement in commodities. It's who I am as fast as I could tell you.
That was a good elevator speech. Thank you, Larry.
Phil.
Phil, I'm sorry.
My background, my name is Phil Duff. My background, I spent much of my career at Morgan Stanley, having run the financial institutions part of investment banking, and then I was CFO of the firm. And then ran the mutual fund business after our combination with Dean Witter. Then I left, and I've been in the hedge fund business since. Did a short stint with Julian Robertson and the team at Tiger Management, and then started a firm called Front Point Partners, which I sold a couple of years ago to my old colleagues at Morgan Stanley. And I've been embarked on launching a new business that's really targeted at organizations with long-tail liabilities. So that'd be pension and medical benefit plans of both corporates and governments, life and P&C companies, as well as endowments and sovereign wealth funds. And the proposition is to find ways to fund those liabilities in more secure, productive, and cost-effective means. And rather than buying individual products, whether they be asset management products or actuaries, custodians, and the like, all on a very a la carte and fragmented basis, to fund those liabilities in a much more integrated, holistic sort of manner. So that's what we're working on. We're still at a fairly nascent stage. This hasn't been a terrific time to kind of launch a novel new business proposition, but one of the things with startups is you have to be perseverant.
This is actually a perfect springboard for our conversation because we're talking about the business of investment management. Let's talk about the past year and what it's meant for this industry.
Well, this past year is obviously we've all lived through an enormous kind of change in the financial world and I think culturally as well. I would think, as I've spent time, and given our biggest market is kind of the largest pension plans around the world, I would have characterized in a year ago this past summer, most pension plan chief investment officers, kind of had a bit of a deer in the headlights sort of perspective, in the sense that while they'd had losses in their equity and credit portfolios before the real crisis hit in the fall, what was most baffling, I think, was whether they were doing more old school type of diversification, stocks versus bonds, value versus growth, or your domestic market versus the rest of the world, or more new school like the Swenson endowment model, if you will, or anything in between. The real problem was none of that diversification was working. Everything was correlated on the downside. And then when the financial crisis really hit its crescendo, I guess marked by the Lehman bankruptcy in mid-September, that deer in the headlights perspective, I think, kind of shifted to kind of total intellectual resignation, which was, I've lived through other crises in the past. Hopefully I'll live through this one too, but I don't know what to do from here. And I think, since that time, we've had enough kind of crisis fatigue, if you will. I'm not sure what returning to normal ever feels like any longer. But I think there's still a lot of uncertainty as to how do I protect myself against the downside in the future? What is the appropriate sort of diversification that can get me through this sort of crisis that we had over the past 24 months. And I think that discussion is still going on very deeply. And I think there's a big opportunity for managers that can not only produce good risk-adjusted returns, but can also help their clients think through and solve that problem.
Larry, would you say is the biggest fallout of the past year? Where are we seeing the impact the most? Is it performance? Is it fees? What is it in your business?
In terms of what I see related to that question, I think the biggest thing is just the sheer lack of leverage that there is out there. When you take a look at this business, for many, many years, it was leverage on top of leverage. So you had managers who were trying to exploit small inefficiencies and put an awful lot of leverage on it. That's gone. Leverage fixed income is not a viable business right now. You had fund of funds who took a look at portfolios and said, well, if I put together 10 different 10% risk hedge funds, that gives me a 5% risk overall, so I'll just leverage it 2 to 1. That, by and large, is gone. So the amount of money that there is pursuing these strategies is a whole lot less than it used to be, which in turn has created a lot of opportunities from an investment standpoint going forward. I have not seen a big focus on fees. Everybody expects it. I think there will be a diminution of management fees, but not of performance fees going forward. But by and large, I think the bigger issue is that there's just not going to be as much money around as there was in the past because of that lack of the many layers of leverage that had existed.
Okay, so there's not as much money to go around. How do you get that money? What is it that's going to give you, as an investor, the edge over everybody else here in the audience?
Well, I think it gets back to basics. What are we trying to produce? What's the whole idea of an alternative investment? Is very simply to produce an uncorrelated return distribution that has a good risk-return trade-off. I think the unrealistic expectations of the 1990s are gone. I think what less leverage means is that nobody's looking at a manager to give them 30% a year anymore. I think what Bernie Madoff means is that people are going to really cross their T's and dot their I's and be very careful about the type of organization that they invest in and make sure that all the non-investment issues are covered as fully as they need to be covered. So the world's really changed dramatically, but I think the way you win in this world is the same way you always won, is to deliver on your investment proposition, which is good returns and uncorrelated returns.
Talk to me a little bit about that overall interchange now with the client. What has changed in the past year? What are they asking from you that they didn't ask before?
Well, in trying to address that, Laura, and kind of expanding on your answer, Larry, I'd submit to you that, kind of in the past, virtually all hedge funds, private equity funds, real estate funds, were kind of sold in the following manner. It was kind of a three-pronged pitch. Here's my investment strategy. Here's the pedigree of the people. Don't they have very smart resumes? And here's the historical record. And while nobody ever said it quite this way, the implication was, QED, you're a bleeping idiot if you don't put your money into this. And I would submit that, in the earlier part of this decade, prior to the financial crisis, where there was arguably more demand for these types of strategies than there was supply, you could get away with that sort of approach. But I think today, where the supply has arguably caught up with the demand side of the equation, simply producing a nice return stream is a prerequisite, but it's one of those classic necessary but not sufficient conditions. The world doesn't need another hedge fund. It doesn't need another private equity fund, yet the clients need an enormous amount of help. The asset liability gaps in pension plans and household balance sheets have only gotten wider. They're harder to close as a result of lower return expectations, higher correlations, more accounting scrutiny on them. So I think finding ways that, in addition to returning a nice time series of returns, figuring out some other value added that you can bring to that client.
Such as, what is the value added? I mean, is it free pens and notepads? Seriously, what is the value added that's going to make them want to be with you? And
well, I think that can vary quite a bit. I watch how my friends at BlackRock have quite successfully used their risk management product, BlackRock Solutions, for example, as their initial calling card for a new client prospect, where they come in and talk about how they manage risk and how their system does that. And I think that leads then to the client saying, gosh, these people are that passionate about managing risk, they're probably pretty good at managing money too. So I think, whether it's around risk analytics, whether it's around liability analytics and hedging, whether it's around portfolio construction, asset allocation, I think figuring out some additional things like that to be able to provide the client